When we get into closing costs, it changes a little bit. The down payment is the term is skin in the game. It's your investment to make sure that you're somewhat committed to this property. If you don't put money in, the thought process is that, if you walk away, you really haven't lost anything. So they want to be some investment. Some programs don't require that, but both FHA and VA do. I'm sorry, both FHA and conventional require a down payment. But on the closing cost side, I'm going to break them down into two categories because I think it's a little bit easier to understand them. There's things that we're going to talk about that are loan-related fees, and there's things that we'll discuss that are property-related fees. Now, this is not a good faith estimate. This is not an official, when you find a property, you provide us with the property address, we will give you a loan estimate. That is an official form that says, here's the fees, and once they've been quoted, there's limits to how much they can change. This is not an estimate for you. This is an idea of how those fees are broken down. So these certainly are subject to change. They should be fairly accurate, but I don't want you to leave here thinking this is the precise number. You will get a loan estimate as part of this process.
So what's the point of closing costs?
To pay things.
Right, but there's already so much payment.
Well, let's talk about what you're paying.
Okay.
Loan related. Nova, me, you're going to pay us a fee. Okay? The lender, whatever company you're with, is going to charge you a fee for doing the loan. You have an appraisal fee. The appraiser's job primarily is to make sure that the home, the value, support the collateral for the loan that's being made. So they might not give you you might not agree with the value of the home. You might think it's worth more, you might think it's worth less. But at the end of the day, the appraiser's opinion is telling us as the lender that if we were to make the loan based upon that home, this is the amount of collateral in this market, so we'll base our decision off of that. You and the seller could agree to pay $200,000 for that house. But if the appraiser thinks it's $150,000, we're going to base our decision off of the $150,000 because that's our safety net. The opposite holds true, though. You might agree to pay $150,000 and the appraiser says it's worth $165,000, but because you and the seller have agreed to the $150,000, that's what we're going to base it off of. You're going to see the lower of the two figures, either the appraised value or the purchase price. But the appraiser's job is not to tell the seller. The appraiser's job is not even to really give you a complete fair market value if you were to sell this home. It's designed specifically for the lender to make sure that the collateral is there. That is different than your home inspection, and we'll talk about that when we get to some of the miscellaneous fees. Then you're going to pay a title fee. The title company, and in Arizona, typically title and escrow, those are two separate services. They're usually combined into one company here in Arizona, although they can be separate. The escrow portion is the management of the contract. You and the seller are going to agree to a purchase price, you're going to agree to a timeline, you're going to agree to certain procedures along the way. The title company, or the escrow company, in the middle of that is going to collect all the paperwork. You will make a good faith deposit called an earnest money deposit, which your agent, I think, has already spoken to you about. That will go and be held by the escrow company. As inspections and invoices accrue that are not paid and are being paid through this process, they will be sent to the title company. A few days before you're set to close, the title company will get the loan documents from us. They will do all the calculations for the taxes the seller is responsible for. They'll have your insurance policy that you've selected. They'll make sure that those people are paid, that your taxes are paid, that the seller gets what they're supposed to get out of the property, that the agents are paid, that the lender's paid. That's their portion of it. They notarize all the documents. That's the escrow side of things. The title piece of that is really researching all of the transfer of ownership that's happened on this property to make sure that when you sign those documents, that when you're handed those keys, you are the rightful owners of that property. Because if along the way anyone else had made a mistake in recording, someone didn't sign that was supposed to have signed, they may still have rights to that property regardless of how many times it's transferred ownership. So if someone in 1920 owned a piece of land and did not sign their rights away properly or it can't be verified that they did, their heirs could come back and say, this is our land. The title insurance is designed to provide protections. So at closing, there's actually two policies that are issued. The seller, on the Arizona contract, unless it's negotiated differently, the standard is that the seller provides you with a policy called an owner's title policy, protecting your interests in the property. And that you, as the buyer, will provide to us something called a lender's insurance policy, protecting our interests in the property. You will select the title company that you use, but initially on, we're going to give you estimates based upon the purchase price of what we think your title fees will be.
Just like with the insurance.
Just like with the insurance. As you move along the process, we'll move from vague theoretical into more specific. We won't know exact figures until we get closer to closing, but the estimates will continue to get stronger, and they're not going to be major changes. You're not going to find a huge difference. So when you get your loan estimate, this will have detailed fees broken out, precise figures. It's still an estimate, but there are limits to what can change at that point. So the title fees that we quote are not going to change by more than 10%. The fees that we quote for us are not going to change. We legally can't change them. I can't tell you up front that our cost is X, and at closing, oh, it's X plus this. It can't change. Unless something is changed in the loan that would affect that, but then you'd have to be issued a new loan estimate telling you that. So now this is more about understanding process. The loan estimate will really hone in on fees. So you understand the difference between title and escrow, appraisal, and then your lender costs. These are loan-related fees, not because we make any money off of your title and escrow, we don't. But we're requiring you to purchase a policy to protect us. We're requiring you to use a title company and an escrow company. We're making you get an appraisal. If you were purchasing a home with cash, you might not want an appraisal. You might, I don't know, but you wouldn't have to get it. So because you're getting a loan, you're paying those fees. So that's why they're loan related, not because they're being charged by the lender. Things that are property related, that's really your taxes and your insurance. I mentioned that we're going to have a 2-month cushion. Well, your taxes, depending on when you close, your taxes could be due the next month, or they could be due in 6 months. We don't know. The seller is responsible for the taxes that on the property until you become the owner. So you will probably get a credit from the seller for all the taxes that they have that they're due, and that can go into that escrow account that we talked about, or that impound account. Your insurance, your homeowner's insurance, that is due 1 year in advance. So you'll be paying, if we were to close today, you'd be paying for your insurance through next year at this time. But then you'll also put 2 months into your impound account. So at closing, you're actually paying 14 months worth of insurance. And the reason why is a year from now, you've made your payments. We need to have enough in there to pay what's due a year from now and have a little bit of a cushion. So 2 months taxes, 14 months insurance is a pretty good estimate. And as we know, your property and your insurance will be able to give you stronger figures.